financial industry has always been at the forefront of technological adoption, but in recent years, no innovation has had a more profound impact than big data. With the exponential growth of digital technologies, finance has entered an era where data is not just an auxiliary tool, but a critical driver of decision-making, strategy, and innovation. The emergence of big data is more than just a trend. It's a revolution, one that is transforming how financial institutions operate, interact with customers, manage risk, and comply with ever-evolving regulations. But what exactly is big data? And why is it so crucial for the future of finance? How did the industry evolve to this point? And what challenges remain? This chapter will explore these questions and set the stage for a deeper understanding of how data is reshaping the financial world. The origins of big data in finance. To fully appreciate the current impact of big data, we must first understand its origins and evolution within the financial industry. Before the digital age, financial institutions relied on paper records and manual processes to manage data. Banks and investment firms would keep ledgers filled with client information, transaction records, and market data, with analysts spending hours, sometimes days, poring over sheets of numbers to find patterns and make predictions. The first significant transformation came with the advent of computers in the mid-20th century. Financial institutions quickly adopted these new tools to automate calculations, speed up record-keeping, and store larger amounts of data. However, even with the introduction of early computers, the volume of data was manageable by today's standards, and analytics remained mostly manual. As the internet matured in the 1990s and early 2000s, everything began to change. Financial institutions could suddenly collect far more data than ever before, not just from their own operations, but from the world at large. Market data, customer interactions, and macroeconomic indicators became available in real time, creating a flood of information that overwhelmed traditional data processing systems. This surge in data gave rise to the concept of big data, a term used to describe datasets so large and complex that they could not be processed by conventional tools. Financial institutions began exploring new ways to store, analyze, and extract value from this vast sea of information, and the big data revolution was born. What is big data in finance? At its core, big data refers to datasets that are too large or too complex for traditional data processing software to manage. In finance, this encompasses data from a multitude of sources, everything from market transactions and customer behavior to social media posts, news articles, and even environmental data. It includes structured data, like transaction records and market prices, and unstructured data, such as text from social media posts or audio from customer service calls. Big data is characterized by three main attributes, often referred to as the 3 V's. Volume. The sheer amount of data generated and stored is enormous. Financial institutions deal with terabytes and petabytes of information daily, especially with the proliferation of digital transactions and mobile banking. Velocity. Data in finance is generated and needs to be processed at incredible speeds. Real-time data processing is crucial for applications like stock trading, fraud detection, and risk management. Variety. Data comes in many different forms, including structured data like databases and spreadsheets, as well as unstructured data like emails, social media interactions, and audio-video files. These characteristics make traditional data tools inadequate, leading financial institutions to adopt new technologies capable of processing, analyzing, and deriving insights from vast, complex datasets. The importance of big data in finance. The importance of big data in finance cannot be overstated. It has become the key to unlocking deeper insights into markets, customers, and risks, helping financial institutions improve their decision-making processes, optimize operations, and enhance customer satisfaction. Predictive analytics and forecasting. One of the most significant applications of big data in finance is predictive analytics. By analyzing historical data along with real-time inputs, financial institutions can build predictive models that anticipate market trends, customer behavior, and economic shifts. For instance, investment firms use big data analytics to predict stock market movements more accurately, giving them an edge in trading. Personalized banking and customer engagement. Big data enables banks to deliver personalized services to their customers. By analyzing transaction history, social media activity, and online behavior, banks can tailor their products to meet individual needs. For example, if a customer frequently uses their credit card for travel-related expenses, the bank can offer them a specialized travel rewards card or related offers. This kind of personalization enhances customer loyalty and satisfaction. Enhanced risk management. Risk management is a fundamental aspect of finance, and big data has revolutionized how institutions approach it. By analyzing vast datasets, banks can now identify potential risks far earlier than traditional methods would allow. For example, by analyzing market data and customer transaction patterns, banks can detect signs of financial distress or fraud and take proactive measures to mitigate losses. Regulatory compliance. As regulations in the financial sector become more stringent, financial institutions must ensure that they comply with a growing number of requirements. Big data helps streamline this process by automating the collection and analysis of compliance data, reducing operational costs, and minimizing the risk of non-compliance. The challenges of implementing big data in finance. While big data offers enormous potential, implementing it is not without challenges. Financial institutions must overcome several obstacles to harness its full power. Data quality. One of the most significant challenges in big data is ensuring that the data being analyzed is accurate, clean, and timely. Poor quality data can lead to incorrect analyses and flawed decisions. Financial institutions must invest in robust data management systems and processes to ensure that the data they collect is reliable and useful. Data security. With the increase in data volume comes an increase in security risks. Financial institutions handle vast amounts of sensitive information, making them prime targets for cyber attacks. Ensuring the security and privacy of customer data is paramount, requiring significant investments in cybersecurity technologies and protocols. Integration with legacy systems. Many financial institutions rely on legacy IT systems that were not designed to handle the demands of big data. Integrating new big data platforms with these older systems can be complex and expensive, often requiring a complete overhaul of existing infrastructure. Regulatory and ethical concerns. With great data power comes great responsibility. Financial institutions must navigate a complex regulatory landscape that governs how data can be used, stored, and shared. Additionally, there are ethical considerations around data privacy and the use of customer information, particularly when it comes to data-driven marketing and decision-making. Real-world applications of big data in finance. Several financial institutions have successfully implemented big data technologies to transform their operations and gain a competitive edge. These real-world applications provide a glimpse into the potential of big data in finance. Fraud detection. A global financial institution used big data to develop a real-time fraud detection system. By analyzing millions of transactions in real time, the system flags suspicious activities, such as an unusually high number of small withdrawals or purchases made in different geographical locations. The system has significantly reduced fraud losses and improved customer trust. Algorithmic trading. Hedge funds and investment firms are increasingly using big data to develop sophisticated algorithmic trading strategies. These algorithms analyze vast amounts of market data, news reports, and social media sentiment to make trading decisions in milliseconds, capitalizing on market opportunities before human traders can react. Customer segmentation and marketing. Retail banks have used big data to segment their customer base more effectively. By analyzing customer spending patterns, demographics, and online behavior, banks can tailor marketing campaigns to specific customer segments, increasing the likelihood of conversion and boosting revenue. Risk assessment and credit scoring. Lenders are using big data to improve credit scoring models. By incorporating alternative data sources, such as social media activity, payment history for utilities and rent, and even mobile phone usage patterns, lenders can more accurately assess creditworthiness, extending loans to individuals who might have been overlooked by traditional credit scoring methods. The future of big data in finance. As big data technologies continue to evolve, the future of finance will likely be defined by even more advanced analytics, automation, and personalization. Emerging technologies such as machine learning, artificial intelligence, AI, and blockchains are poised to further enhance the ability of financial institutions to process and analyze data. Machine learning and AI. Machine learning algorithms will allow financial institutions to analyze larger datasets and identify patterns that would be impossible for human analysts to detect. AI-powered tools will continue to automate customer service functions, fraud detection, and even investment decision-making, allowing institutions to operate more efficiently and at scale. Blockchain and distributed ledger technology. Blockchain technology offers the potential to revolutionize how financial data is stored and shared. By providing a secure, decentralized ledger, blockchain could improve transparency, reduce fraud, and streamline regulatory compliance. Personalized financial services. As big data analytics become more sophisticated, financial institutions will be able to offer hyper-personalized services to their customers. Everything from investment portfolios to insurance plans will be tailored to the individual's unique needs and preferences, leading to greater customer satisfaction and loyalty. Big data has ushered in a new era for the financial industry, offering unprecedented opportunities to improve decision-making, manage risk, and deliver personalized services. However, realizing the full potential of big data requires overcoming significant challenges, from data quality and security issues to integration with legacy systems and navigating complex regulatory environments. As we progress through the book, we will delve deeper into the various applications of big data in finance, examining how it is reshaping the industry and what this means for the future. The financial institutions that can successfully harness the power of big data will be well positioned to lead in this new data-driven world, setting the stage for innovation, growth, and success in an increasingly competitive landscape.